20 players walk into a dark arena. Fog rolls across the floor. Black lights pulse against neon obstacles. For the next 10 minutes, they chase each other through a maze, firing infrared beams at sensor-packed vests. When the session ends, they file out laughing, and a new group shuffles in. The operator just collected $200 in ticket revenue, 20 players at $10 each. The direct cost of running that session, electricity, minor wear on equipment, payment processing, is a fraction of what came in. The incremental margin on an additional game is extremely high because the operator consumes almost no physical inventory. No raw materials are depleted, no product ships. The session itself is the product, and it costs almost nothing to deliver once the arena exists. That number sounds like a dream, and it is the single most misleading feature of the entire business, because a laser tag arena does not fail from low margins on a busy Saturday night. It fails from what happens at 2 o'clock on a Tuesday afternoon, when that same arena sits empty, the fog machines are cold, and the lights are off. But the rent is still accruing. Wages are still owed. Insurance, utilities, equipment depreciation, and loan payments do not pause because nobody showed up to play. A game can have extraordinary incremental economics while the business itself produces much thinner returns after rent, payroll, insurance, maintenance, marketing, depreciation, and financing. The distance between the economics of a single session and the economics of the business that produces it is the entire financial story. A mid-sized standalone laser tag arena in the United States typically occupies 5,000 to 10,000 square feet of leased commercial space. Inside that footprint is the arena itself, usually 3,500 to 4,500 square feet for 24 to 30 simultaneous players. A ratio LaserBlast, a major equipment manufacturer, recommends at roughly 150 square feet per player. The rest of the space holds a lobby, registration counter, 1 or 2 party rooms, restrooms, and maybe a small concession area. Building this costs money, and the costs stack in layers. Based on operator planning data and financial models from multiple sources, arena construction and build-out can run from roughly $140,000 to over $300,000 depending on them in complexity. Laser tag equipment, 24 to 30 battlesuits with phasers, vests, sensors, and a central scoring computer adds another $50,000 to $120,000. Obstacles, lighting, fog machines, sound systems, party rooms, lobby, and technology infrastructure layer. On further. In practice, these categories overlap significantly. Build-out budgets often include basic obstacle construction and lighting. An operator choosing high-end theming is unlikely to also maximize every other budget line. The result is that real-world total capital expenditure clusters into tiers rather than adding linearly. A lean standalone arena lands around $200,000. A mid-range build-out with professional equipment runs $300,000 to $450,000. A premium, fully themed facility can push well beyond that, but construction is only the cost of building the thing. Operating it while it finds its audience costs more. Financial pro formas, including one detailed model projecting a 14-month path to operational break-even, show that the operator needs months of working capital to survive the ramp-up period. For a serious standalone project, the real capital requirement can be hundreds of thousands of dollars beyond the equipment invoice itself. Each layer of cost is distinct. Much of the arena-specific build-out becomes economically difficult to recover once it is installed in leased space. The equipment carries a financial model useful life of 5 to 7 years, though physical lifespan varies widely with quality and usage intensity. The working capital is consumed month by month until revenue exceeds expenses. An operator who funds the build-out but underfunds the working capital faces a liquidity crisis even if the long-term economics are sound. This, according to multiple industry consultants, is the most common mechanism through which otherwise viable laser tag businesses fail. That is the price of admission into a business that charges $10 a game. The product being sold inside this facility is not a laser beam. It is a 10 to 20-minute block of time inside a physical space. And time, unlike a product sitting on a shelf, expires. An unsold game session at 2 in the afternoon is gone by 2:15. It cannot be stored, discounted tomorrow, or shipped to a different market. It simply ceases to exist. This makes a laser tag arena structurally identical to a hotel. A hotel room unsold tonight generates zero revenue tonight, regardless of what happens tomorrow. The economics of both businesses revolve around a single variable: utilization. What percentage of available capacity is actually filled across all hours, across all days? According to performance benchmarks that LaserBlast publishes from its operator install base, the industry average for a laser tag arena is approximately 30% blended utilization. That figure is broadly consistent with data from other manufacturers and operator surveys, though no independent audit of industry-wide utilization exists. 30% is not 30% at all times. It is the average of two very different realities. LaserBlast's data indicates that weekday afternoons average 8 to 10%. Weekend evenings climb to 35 to 55%, sometimes reaching 70 to 90% during peak Saturday hours. Here is where the math matters, and where it requires careful assumptions. For this calculation, assume a 25 to 30-minute session cycle from start to start. That includes the briefing and suiting up, 10 to 20 minutes of gameplay, equipment collection, score display, arena reset, and the cleanup interval before the next group enters. Under that assumption, an arena realistically runs 3 to 4 complete sessions per hour, not the 5 or 6 sometimes projected in optimistic capacity models. Using the conservative end, 3 sessions per hour, an arena with 30 player slots operating 14 hours per day has a theoretical daily capacity of roughly 1,260 player games. At 30% blended utilization, actual throughput is about 380. On a slow Tuesday at 10% utilization, it drops to 126. Using 4 sessions per hour, those numbers rise to 1,680 theoretical, 504 at 30%, and 168 on a slow Tuesday. At $10 per player game, the range of daily revenue at 30% utilization runs between roughly $3,800 and $5,000. On a slow Tuesday, between $1,260 and $1,700. Daily fixed costs, rent, base staffing, insurance, and utilities run continuously regardless of attendance. The math is survivable on weekends. It is punishing on weekdays. And the weekly average, not the Saturday peak, determines whether the business makes money. This is the core structural tension. An arena opens 7 days a week, operates on a revenue curve that peaks sharply on Friday and Saturday evenings, and flatlines for most of the remaining 100+ hours. The operator cannot close on Tuesday and Wednesday without signaling decline to customers and undermining the walk-in traffic that does occasionally materialize. But staying open means staffing, lighting, heating, and maintaining the facility during hours that may generate less revenue than they cost. The operator is trapped between the economics of closing and the optics of closing. Neither option is particularly good for the operator. Those fixed costs are severe. According to operating expense guidance published by Laserforce, one of the largest equipment manufacturers, and a company that also operates its own venues, the two largest line items, rent and wages, together consume approximately 45 to 50% of gross revenue for a typical standalone arena. Laserforce specifies wages at roughly 25% of gross takings and recommends that rent not exceed approximately the same. To illustrate the scale, one current U.S. laser tag financial model, a commercial planning template rather than an industry average, uses $12,000 per month as its rent assumption, with approximately $21,000 per month in payroll and roughly $42,500 in total monthly operating costs. That model is a planning tool, not proof that every mid-sized arena has these exact expenses, but the proportions are consistent across multiple sources. Rent and wages dominate, and they do not flex downward when business slows. Insurance, utilities, and equipment maintenance add further fixed and semi-fixed layers. The specifics vary by location, climate, and equipment quality, but these costs share the same characteristic. They continue whether the arena is full or empty. The industry has a metric for this problem: revenue per available hour, sometimes called REV-PAH. It measures total revenue divided by total hours the facility was open. During a Saturday peak, this number can be high. On a slow weekday afternoon, it can drop below what the rent alone costs per hour. When that happens, the arena is paying for the privilege of being open. There is a solution to this problem, and it does not involve laser tag at all. It involves birthday cake. For many standalone laser tag arenas, the single most important revenue stream is not walk-in game sessions. It is pre-booked birthday party packages and group events. Laserforce's own customer analysis identifies children aged 7 to 13, typically booking birthday parties, as the largest demand segment, with corporate and team-building events and family groups also significant. The exact revenue share varies by operator and market, but parties and group bookings are consistently described as among the most critical revenue streams for standalone arenas, and often the largest single category. Depending on the market and what is included, laser tag birthday packages can run from a few $100s to $800 or more. Current listings show themed party packages at $700 to $800 for 25 children at the upper end, with simpler packages starting much lower. If an arena averaged 4 $500 party bookings every weekend, that alone would generate $100,000 a year. The margin on those events is higher than walk-in play because the operator has pre-sold the capacity. There is no utilization gamble. The party room is booked, the arena time is reserved, the staff is scheduled. This is the business the operator is actually running, not a laser tag arena, a birthday party venue that uses laser tag as its entertainment amenity. The arena is the customer acquisition engine. The party package is the profit center. The implications go deeper than revenue mix. A party-driven business has fundamentally different operational priorities than a walk-in entertainment venue. It needs a dedicated party coordinator whose sole job is converting inquiries into bookings. It needs a compelling party room, not an afterthought in a back hallway. It needs a streamlined online booking system that captures deposits. It needs a food program reliable enough that parents trust it to feed 28-year-olds without incident. An operator who builds the most elaborate arena in the city but neglects this infrastructure is optimizing the wrong part of the business. The kid turning 8 this year turns 9 next year. The parent who had a smooth experience already knows the phone number. The history of laser tag is short enough to fit a single uncomfortable lesson, and it takes 2 stories to tell it. George Carter III opened the first commercial laser tag arena on March 28, 1984 in Dallas, Texas. Inspired by Star Wars, he built Photon, a scored team combat game using infrared technology inside a purpose-built arena with fog, lighting, and sound effects. It was an immediate sensation. Laser tag became a cultural phenomenon, and Carter expanded aggressively through franchising, reaching 46 locations. Then, the initial novelty faded. Home gaming consoles emerged as direct competitors. Investor enthusiasm cooled. Franchisees who had invested heavily in arena buildouts watched foot traffic decline while their lease payments stayed fixed. By 1989, Carter sold the company. The parent company closed without formal bankruptcy, but the enterprise value was gone. The lesson from Photon is less about the technology than the economics. Expansion multiplied exposure to a fixed-cost business whose demand had not yet proved durable. The concept itself survived for decades. The rate of expansion did not. 31 years later, a different demand shock destroyed the industry's largest chain. Laser Quest, operated by Mississauga-based Versant Corporation, had grown over 27 years to 36 locations across the United States and Canada, with over 100 worldwide. On March 15, 2020, COVID-19 lockdowns shut every location simultaneously. Revenue went to zero. Costs did not. Indoor entertainment venues were among the last categories permitted to reopen. Even jurisdictions that allowed limited reopening imposed capacity restrictions that made normal operations economically unviable. An arena built for 30 players running at 7 or 8 per session does not cover its costs. On September 22, 2020, Versant announced permanent closure of all North American Laser Quest locations. Contemporary reporting confirmed the shutdown of 36 locations across the United States and Canada. Some locations later reopened under new independent ownership, but the chain itself was gone. Photon's expansion exposed what happens when a fixed-cost model meets fading novelty. Laser Quest's collapse exposed what happens when a fixed-cost model meets a demand shock severe enough to eliminate revenue entirely. The underlying mechanism was identical. Every location these companies added multiplied revenue during good years and multiplied cash burn during bad ones. Neither company had a fallback. Total dependence on physical foot traffic into a single-purpose facility multiplied across dozens of fixed-cost locations. The operators who appear to have understood this vulnerability best are the ones who refused to build standalone arenas. One way operators reduce this vulnerability is by putting laser tag inside a broader family entertainment center. An FEC combines laser tag with bowling, arcade games, go-karts, climbing walls, food and beverage, and dedicated party rooms inside a much larger facility. Laser tag typically occupies 3,000 to 5,000 square feet within the broader complex. The FEC model addresses the utilization problem through diversification. When laser tag sits empty on a Wednesday afternoon, other attractions may still generate revenue. The laser tag arena does not need to independently justify the entire facility's rent. It needs to contribute its share alongside other revenue streams. The concept is straightforward but powerful. The FEC captures more spending from the same visit because the customer can buy multiple attractions, food, drinks, and party packages instead of a single laser tag session. A family that visits a standalone arena pays for laser tag and leaves. A family that visits an FEC may play laser tag, bowl, eat lunch, and spend time in the arcade before leaving. Every additional touchpoint is additional revenue from a customer who has already walked through the door. To take one concrete example, a recently profiled 34,000 square foot FEC in the United States combines a 4,500 square foot laser tag attraction with bowling, axe throwing, an arcade, a restaurant, and party rooms. Laser tag occupies roughly 13% of the total space but serves as the anchor attraction that draws families through the door. Industry trade sources, including references to IAAPA survey data cited by multiple FEC consultants, position laser tag as one of the highest revenue per square foot attractions in the family entertainment center category. Birthday parties become even more potent inside an FEC. Instead of selling 30 minutes of laser tag and pizza for $350, the FEC sells a multi-attraction package with laser tag, bowling, arcade credits, and a full meal for $500 to $800. The package bundles multiple revenue streams into a single booking that commands premium pricing. The structural advantage is not just higher revenue, it is resilience. A standalone arena that loses its Saturday birthday bookings to a competitor has no fallback. An FEC that loses some laser tag traffic can absorb the hit across its other attractions while it adjusts. The diversification does not eliminate risk, but it changes the math from binary, either the arena fills or it does not, to graduated, where weakness in one area can be offset by strength in another. Behind the scenes, the operational machine runs on a rhythm most customers never see. The difference between 3 sessions per hour and 4 during a 6-hour Saturday peak, at $200 average session revenue, is $1,200 per Saturday. Across 52 weekends, that operational gap represents roughly $62,000 in annual revenue. The most economically consequential skill in this business is not arena design. It is throughput management. Faster vest-up routines, tighter briefings, smoother transitions between sessions, reliable equipment that does not malfunction during the Saturday rush. High staff turnover, a persistent challenge in entertainment venues, makes this harder. Every departure takes institutional knowledge about how to run a tight session cycle out the door. Equipment quality feeds directly into this equation. One of the most frequently cited failure points in laser tag systems is the phaser cord, the cable connecting the gun to the vest. On budget systems, according to multiple manufacturer comparisons, these cords can fail within months. LASERTRON, a premium manufacturer, advertises phaser cord lifespans of 10 years or more and offers what it describes as a lifetime warranty on them. iCOMBAT, which tracks downtime costs across its operator network, estimates that each equipment malfunction during a peak session costs $300 to $500 in lost or delayed revenue. The revenue loss is only part of the damage. A broken phaser during a Saturday birthday party creates a cascading problem. The birthday child's group waits. The next session starts late. The group after that arrives to find the lobby backed up. Within an hour, a single equipment failure has degraded the experience for 3 separate customer groups. Some of those customers will not return. The cost of that lost future revenue never appears on any financial statement, but operators who have lived through it describe it as the most expensive invisible expense in the business. Over a 5 to 7 year total cost of ownership horizon, which iCOMBAT uses as its standard evaluation window, a cheaper system requiring frequent repairs and eventual full replacement may cost substantially more than a premium system that runs reliably for the full period. The math is not subtle, but it requires thinking in total cost of ownership rather than purchase price, and that is a discipline many first-time operators lack. There is a question underneath all of this that the utilization rates and the failure cases have been circling. Who captures the most predictable economics in the laser tag value chain? The standalone arena operator bears the full weight of demand risk, fixed costs, staffing challenges, and equipment maintenance. Laserforce's guidance suggests that efficient operators can achieve 15 to 40% profit after management wages, but before tax, interest, and depreciation. That is a wide range, and the lower end leaves little margin for error once financing and tax obligations are accounted for. The landlord, by contrast, collects monthly rent with limited downside once the lease is signed. A 10-year commercial lease at $12,000 per month represents $1,440,000 in total. Committed payments, typically backed by the operator's personal guarantee, which shifts the default risk partially back to the operator even if the business closes. The landlord carries releasing risk if the tenant fails. And finding a new tenant for a space with a half-demolished laser tag arena is not trivial. But that risk is qualitatively different from the daily operational exposure the arena owner absorbs. The equipment manufacturer creates switching costs through system lock-in, since changing brands means replacing every phaser, every vest, and every software integration. Manufacturers generate recurring revenue from replacement parts, software updates, and system upgrades. They bear no utilization risk from any individual location, though their long-term business depends on a healthy installed base of operators. The pattern is striking. The participants with the greatest distance from daily operations often have more predictable revenue, while the operator absorbs the greatest utilization risk. The person closest to the operation, the one signing the lease, hiring the game masters, and fixing broken phasers at 9 on a Saturday night, captures the most volatile share. The failure mechanism for a competent laser tag operator requires nothing dramatic. It requires a competitor. A new family entertainment center opens within a 15-minute drive. It offers laser tag as one of 6 attractions. It runs birthday party packages at $500 with bowling, arcade credits, and a full meal included. The standalone laser tag arena across town offers 30 minutes in a dark room and pizza for $350. Birthday party bookings drop. Walk-in traffic follows. Weekend utilization drops from 50% to 30%. Revenue declines substantially. Fixed costs decline barely at all. Monthly cash flow turns negative. This is operating leverage in reverse. The same economic structure that makes a good month feel extraordinary, because each incremental player costs almost nothing to serve. Makes a bad quarter devastating, because the costs that consume roughly half of revenue do not shrink when revenue does. The operator cuts marketing, which accelerates the revenue decline, defers arena refresh spending, which makes the experience feel stale compared to the shiny new competitor, reduces weekday hours, which saves modest wage costs, but signals decline to the remaining customer base. The working capital reserve, originally sized for the startup ramp, gets consumed covering operating losses. Equipment loan payments continue. The commercial lease, with years remaining, cannot be broken without a penalty that would wipe out whatever cash remains. Within 12 to 18 months, the operator exhausts liquidity. The arena closes. Much of the custom build-out, obstacles, lighting, and fog systems affixed to leased space is economically difficult to recover. The equipment can be sold at a fraction of its original cost. The personal guarantee on the lease becomes a liability that follows the operator long after the last phaser goes dark. The financial equation for this business reduces to one relationship. Revenue equals available player capacity multiplied by utilization multiplied by realized price per player. Operating profit equals that revenue minus variable costs minus fixed and semi-fixed costs. The variable costs are small enough per session that they barely move the equation. What moves it is the ratio between revenue and the fixed cost base. When utilization exceeds break-even, each additional percentage point flows almost entirely to profit because those small variable costs are the only incremental expense. When utilization falls below break-even, each percentage point decline accelerates cash burn because the fixed costs do not adjust. One market research estimate puts the global laser tag market at roughly $1.8 billion in 2025, with projected growth of about 9% annually through 2034. The exact number is debatable. The direction is not. Demand is not the problem. People want to play laser tag. Parents want their kids to play laser tag. Corporate teams want to run around in the dark shooting each other with infrared beams. The market is real and it is growing. The problem is the structure of the business that delivers it. Laser tag is not a bad business because each game is expensive to operate. It is a dangerous business because the operator has to keep an expensive physical asset occupied. The operator who understands this, who sees the business not as an entertainment venue, but as a utilization problem that happens to involve infrared phasers, who builds the party booking machine before the arena, who embeds the attraction inside a diversified platform rather than betting everything on a single dark room, that operator has a chance. Everyone else is paying rent on an empty arena.